If I told you that making one change to your investing strategy now could change your lifetime investing returns from this to looking more like this, would you try it?
Well, the latest reports show that inflation is predicted to hit 18% in early 2023, which is going to be catastrophic for most investing portfolios. So I went on a mission to find the best high inflation investing strategies, because if we don't react to this, we could potentially lose a lot of money and do a lot of long-term damage to our investment. So I'm going to show you the most popular strategies out there that I've found to see if we can use any of them ourselves to build a perfect portfolio and get the best returns possible in these unprecedented times. Because the economy really is in a crazy state. With the current UK inflation rate sat at 9.9%, it has steadily been rising since the beginning of 2021 when it was less than 1%. And you don't need me to tell you that that's bad news. Things are getting more expensive at a ridiculous speed. I remember the £1 for a 4-pint of milk days. Those were the times. But the damage doesn't just stop at the shops. Even our investment returns are getting secretly slashed into. If you're investing in a global equity portfolio, then you're probably already down 5 to 10% for the year, maybe more. But when we consider returns in real terms, as in after inflation, our money now has less purchasing power. So those returns are now looking more like -15 to -20%. I know, that's getting into some seriously red numbers, but it could get even worse if this report from Citi turns out to be true. They expected the Consumer Prices Index, which is a standard measure of inflation, to exceed 18% in the first quarter of 2023. So if that turns out to be true, then our investments would need to exceed at least 18% annual returns just for us to break even. The Bank of England and other central banks across the world are currently increasing interest rates in an attempt to battle the rising inflation. But even they admit on their website that they expect inflation to fall back to the normal rate of around 2% in around 2 years. That's going to be a long time for us to deal with a high inflationary environment, which is going to be detrimental to our investing returns. So in the meantime, I'm going to research what better investing strategies are out there to see if we should change our current investing portfolios in an attempt to profit from this rising inflation.
And after some research, I came across an investment that had a lot of promise.
And this one actually makes a lot of sense, because inflation is typically tied to an increase in the cost of raw materials, otherwise known as commodities. So if the price of commodities is to increase, it makes sense that investing in commodities would turn a profit. There are a few different ways that you can do this, the first of which is to invest in precious metals, with gold being the most common option. Investors typically move their cash over to gold to try and protect it from inflation. And it is this increase in demand for gold that gives it a value. The higher the demand for gold, the higher the price will be. So in times like these, when inflation is so high, the price of gold should increase and act as a hedge for the rest of your portfolio. And we can see this by looking at the data over the past year. As inflation started to seriously ramp up in March of 2022, this iShares physical gold ETF also saw a jump in returns of almost 20%. So it seems like investing in gold would be a great idea. But there's a problem. For us investors who don't already own a portion of gold in our portfolio, we're now going to be purchasing gold at an already inflated price. The truth is that we're late to the party, and we've missed out on all of the fun. But you might be thinking, it has been predicted that inflation is going to keep on rising, so surely the price of gold is going to keep on rising. But the problem here is that investors are already aware that we're expecting a rise of inflation in the future, so this information is probably already priced into the market. People have already moved over to gold with the expectation that inflation is going to be at a high rate for the next few years. And this actually works against the idea of investing in gold, because unless inflation rises by an unexpected amount, we're talking above 20%, then it's unlikely that we're going to turn a profit from investing in gold today. Even if we turn to other commodities, the story will be the same. If we look at the Wisdom Tree Enhanced Commodity ETF, the past year of returns is almost identical to the gold ETF that we just saw. So unless we are already invested in commodities before this high inflationary period started, it is unlikely that we're going to profit from adding them to our portfolio. And that would mean that we'd need to make a long-term change to our investing plan, permanently adding commodities to our portfolio in an attempt to hedge ourselves during these high inflationary periods. But the problem is, that doesn't align with my personal strategy of investing in a globally diversified equity portfolio. I don't always want to have some commodities in there just to try and protect me when inflation rises. That'd be like walking around the UK with a pair of flip-flops on every single day of the year. Yeah, when the sun's shining, you might be glad that you have them on. But for the other 95% of the time, where it's either freezing cold or it's raining outside, you're probably going to regret it.
So I continued doing more research and came across an asset class that was even more promising.
And this other asset class is similar to commodities, in the sense that they're not too common to be held within a normal investing portfolio. It is known as a REIT, or Real Estate Investment Trust. and it is the equivalent of an ETF or index fund, but for property investing. They essentially pull together money from investors and then use that to purchase and manage a property portfolio. The idea is that the income that is generated from all of these properties, as in the rent that they receive, is then shared amongst the investors, similar to receiving a dividend from a stock or ETF. And they are known for having a strong yield, or dividend, meaning that investors can generate a steady stream of income without having to own or get involved with any property directly. This is particularly appealing to investors because you're able to diversify your investments across multiple properties or regions, which is basically impossible to do when starting out your own property portfolio, as you typically have to start with just one property, which carries a lot of concentration risk. When inflation is at a high level, like it is today, the argument for REITs is that the value of homes and the prices of rent tend to increase when prices do, meaning that you can maintain a steady dividend income even when inflation is high. We all know that property prices have gone through the roof this year. The market is on fire. So let's see how UK REITs are performing this year. You what? The problem is with high inflation is that this is typically followed by rising interest rates, which is something that we've already seen. And ultimately, this worries investors because of the uncertainty that comes with rising mortgage payments. You could argue that investors are simply overreacting, and that REITs are currently undervalued because of it. But either way, global REITs are currently down more year to date than global equity markets. And that's not my idea of an inflationary hedge. I need a lot more certainty in earning a higher return before I jump in and change my entire investing portfolio. The search continues.
So I persisted in my research and finally stumbled across my final hope of profiting from this inflation.
Tips. Treasury inflated protected securities. Surely this is the answer. It literally says it in the title. These are US Treasury bonds that are tied to inflation, which is meant to protect investors from the decline in the purchasing power of their money. It works by increasing the fixed income that you receive from the bond depending on the inflationary amount. So let's say that you own £2,000 in tips and are set to pay out 2% per year. In a normal year, you would receive 2% of £2,000, which is 40 quid. But now let's say that inflation is at 10%, which it is now. You need to add 10% to the £2,000 that you own, taking that to £2,200, and then you receive 2% of that, which is £44. Another way of putting it is that the amount of fixed income that you would receive from the bond is going to increase by the amount that inflation is currently at. The equivalent asset of tips in the UK are known as index-linked gilts, and you can typically invest in them through a range of ETFs or index funds. So surely after a year of rising inflation, with inflation expected to go up even further, this has been a strong performing year for these assets. Well, the total returns of this iShares Tips Bond ETF is down 9% year to date, and this Xtrackers Global Inflation Linked Bonds ETF is down about 15% year to date. Unfortunately, it's been a rough year for bonds in general, and the increased yield that we're getting from these inflation-linked bonds has not been enough to offset the decrease in the value of the bonds themselves. Besides, it turns out that these inflation-linked bonds typically offer lower yield than standard bonds. So even with the boost that we're getting from inflation, the yields aren't actually that impressive. So now that's three different asset classes that are supposed to hedge our portfolios when inflation is high, but they have all let us down. Because the reality is that the performance of all of these asset classes is not just dependent on one economic factor, such as inflation. The economy and stock market in general are both complex beasts. It's not always clear to know how different markets are going to react to different changes in the economic landscape. Although certain trends do exist, and some assets have strong histories of performing well when inflation is high, that doesn't mean that it's always going to turn out that way. Absolutely nothing is certain in investing. And if it was, then it wouldn't be considered risky. And with risk being directly proportional to reward, that would mean that you would not be able to profit from it.
So I have to watch whilst the economy becomes inflated and whilst I feel deflated that I can't do anything about it. But then I realised that maybe I was asking the wrong question all along.
After looking back over my own investing plan, I realised that I invested in my portfolio for a reason. I chose to invest in a globally diversified equity portfolio, which is a strategy that I believe in, and I didn't intend on changing that when the economy fell apart. So my investing strategy hasn't actually changed, but my capability to invest has, with the cost of living going up, which makes it more difficult to save money. This has made me realise that focusing on our personal finances is the most important thing that we can do during these times. We have no control over what the stock market or the economy is doing, but we do have some control over how much we save and how much we invest. One of my favourite graphs is this one from Vanguard, which shows how our savings rate will dominate the total returns that we receive. The total portfolio value is on the y-axis, with the investing years on the index. The dotted lines show some return profiles with an estimated 4% annual return, whilst the solid lines show the same with 8%. Now the three different colours represent three different types of savings, with orange showing no increase in annual savings, grey showing a 5% increase in annual savings, and red showing a 10% increase. Now with inflation being so high, we're currently in a low return environment because inflation is eating into our real returns. So for now, let's just focus on the dotted lines because they show the examples with the lowest investing returns. Just look at the difference in time for the three colours to reach a 300k portfolio value. It takes the orange line nearly 50 years with no increase in annual savings, yet the other two only take around 28 and 20 years. Now I'm not suggesting that everybody suddenly increases their saving rate right here, right now, because that's obviously going to be difficult with the cost of living being so high. But this graph still shows how big of an impact how much we save will have on the total portfolio value that we end up with. My point is that focusing on making changes to your investing portfolio to try and get higher returns when inflation is high is simply a loser's game. You will be far better off spending your time and energy on figuring out how to save as much money as possible so that you can keep investing during these difficult times.
But even after you start to understand this, there's still more work that you can do to make sure that your returns look more like this one on the graph.
You need to make sure that you're not invested in funds that are harmful to your investing portfolio, which is a mistake that so many investors make. And that's why you need to watch this video here, where I show you how to look out for the most dangerous investing funds on the market.